Hello, I'm Brian Beaulieu, and welcome to the October 20th, 2023 Fed Watch. The mantra at the Fed seems to be higher for longer, and certainly the recent producer price index and CPI data adds credence to that approach. I've also touted would be what's called the stronger than expected retail sales results for September. Be careful about that. Stronger than expected. The expected is in quotes. It depends on who's doing the expecting and how weak they thought it was going to be. The seasonal rise, we look at that at ITR Economics. The seasonal rise in that 3-month moving total off the March seasonal low is weaker than each of the last 4 years. And you look at 1 month, you can get a little bit of a mixed signal. We look at that seasonal trend being weaker than the last 4 years. I mean, that's telling in that there is some slowing down going on in the consumer sector, but incomes are still going up. We don't want this thing to collapse, but there is some slowing. Part of that mantra of higher for longer is the Fed needs to see the economy weakening some more, to get more confidence in their outlook or desire for that 2% core inflation rate. I think they're going to get it. The Israeli-Hamas war certainly is a threat. We haven't seen the move yet, but we are seeing where a path forward where oil prices could certainly go a lot higher than where they are right now. And if that were to happen, that would put a crimp in retail sales once you exclude gasoline stations and home heating oil prices, but it would put a crimp in other discretionary income levels. So that's clearly a threat to the economy that the Fed has to be considering. And when all of this potential for a shutdown in November 11th, I believe, and our inability to find a Speaker of the House is another risk factor. From their perspective, I'm not really concerned about it in terms of what it means for the economy. I'm much more concerned about the ongoing tightness in the credit markets for consumers and businesses, the ongoing weakness that we see in corporate profitability. Those are eroding factors that are going to take a while to play out, but they're pointing toward a softer 2024. And one of the solace points that I had before about an hour ago was corporate bond prices hadn't gone up like the 10-year government bond yield, but now they have. The corporate bond, long bond, 20 to 30-year average jumped 51 basis points in a month, and we're now at the highest level in about 14 years. That's significant. We just saw that cost basis for leverage in businesses jump 0.5 percentage point at a time when corporate profits aren't doing that well, at a time when the stock market isn't doing that well. That's a big deal. And now we're looking at the 10-year government bond yield pushing on, well, it's getting up toward that 5% level. We're not quite there yet, but it is certainly getting there. It's at 4.91%, which is really unimaginable from a year ago. That doesn't have so much to do with inflation. It has to do with our government's insatiable need for leveraging the spending that we can't afford, and it has to do with the inverse yield curve pulling people away from the 10-year side of the spectrum and going with the shorter side of the spectrum. And the more we've thought about it over the last week, the more I think that because 4.91 or 5% on the 10-year government bond yield doesn't hurt businesses. It's the corporate bond yield that really matters when it comes to an impact on businesses. A much tighter correlation there than with the 10-year government bond yield. This may be a blessing in disguise. And this is something that former Dallas Federal Reserve President Fisher pointed out recently, and that is, and we had talked about this last week, we're now looking at only 70 basis point difference between the short and the long interest rate. So the market, in terms of the 10-year government bond yield is doing a lot of the Fed's work for them. We just need to get that 70 bips on the downside, hopefully sooner rather than later in 2024. And we'll have a normalized yields curve, and that gets us back into the path of normalcy, which is something that we need for 2025. So to sum up, we still see more downside pressures than anything for 2024, including Israeli-Hamas war and what that could mean for oil. So even with the tick up in the producer price index and inflation, we're not really changing our outlook for what's likely to happen with interest rates. We talked last week about how a tick up is not unusual. And so we're not worrying about the latest data. We're more worried about seeing the economy maintain a soft recession rather than a harder recession. But for now, we think we're still on track with that 2016-17 dynamic for the downturn in industrial production, manufacturing, and the softness in GDP. That's the update for this week. Thank you for watching. We'll see you next week.